Hi there, thanks again for joining me. This is part 2 of section 19 and paragraph 12 Cap A recording. I do hope that you've been through the first part because in this part I am only going to focus on practical examples with the assumption that you are well aware of the theoretical background. Okay, so let's look at the first example. But first, what I want to do, I want to look at the required so that I know what is expected. Supported by calculations and with reference to the income tax legislation, normal tax implications of the transaction for Scrapbook Pty Limited for the company's current year of assessment. Right, we can see there that the focus of this question is on discussion, but there are some calculations that we need to do to support that discussion. And most importantly, we are told that you also need to provide section references. Okay, let's read the scenario. First, before we read the scenario, I want us to have a certain thinking process. Okay, now with section 19 and paragraph 12A, we need to ask ourselves a few questions. And those questions must be at the back of our mind when we're reading the questions. Okay. So the first question we're going to ask ourselves is whether or not section 19 is applicable. Okay, so when is section 19 applicable? There must be a death benefit. Okay, so when we're reading through the scenario, we want to see whether or not there is a death benefit. And we also want to see whether or not that debt benefit is as a result of a concession or compromise. That's what we're looking for when we're reading the question as well. Okay, and once we've established that there is a debt benefit as a result of a concession or compromise, we're going to ask ourselves, what was that debt used for? Okay, was it used to pay for a tax-deductible expense? Was it used to pay or to buy trading stock that is no longer on hand? If that's the case, then we're going to apply section 19(5). Then, if that's not the case, you're going to ask ourselves, was it used to acquire trading stock and that trading stock is still on hand? If that's the case, then we're going to use section 19(3) to reduce the cost of that trading stock, and any balance remaining will be recouped in terms of section 19. Okay. Alternatively, we're going to ask ourselves if that debt was used for the purchasing of a capital asset, and if that's the case, we then take it a step further and see, was it an allowance asset or a non-allowance asset? Okay. Once we've done that, we ask ourselves more questions further to see, this asset, is it still on hand at the date that the debt benefit is granted or has been sold? Okay, if it has been sold in the previous year of assessment and the debt benefit only arises in the current year of assessment, the calculation will be different, and we need to take note of that. Okay, so once you're comfortable with that, then when you're reading the question, it's going to be so much easier. Scrapbook Pty Limited, a VAT vendor. I want you to underline the word VAT vendor. Okay, with the December year end, I also want you to underline December. Okay, Scrapbook Pty Limited is one of many retailers selling snapshot products locally. Scrapbook Pty Limited has been experiencing serious financial difficulty over the past few months and has requested a concession for its debts from several of its creditors in order to try and regain financial stability. We can see there that there is a hint that there may be section 19, but we don't know for sure that there is because we will need more information to establish that. Okay, on 31 December of the current year, Scrapbook Pty Limited's creditor account for snapshots records amounted to 475,000, which represented trading stock purchases made on credit during the prior year of assessment. Okay, so at the end of the current year, Scrapbook owed 475,000 to Snapshot, and that debt related to straight trading stock purchases. You've got an idea now of which sections are going to be applicable, and I hope you're writing that down for yourself. Okay. Scrapbook Pty Limited has requested a concession of this debt from Snapshots. Okay. Scrapbook Pty Limited still had 150,000 of this trading stock on hand at the beginning of the year of assessment, as well as at the end of the year of assessment. The request for 475,000 debt concession was granted on 31 December of the current year. So now we have all the information that we need. Now, let's decide together whether Section 19 is going to be applicable. Do we have a debt benefit? Yes, we do have a debt benefit of 475,000. Right. Is that debt benefit as a result of a debt concession or compromise? Yes, it is because of a debt concession. So we can see there that it was for commercial reasons. It was not a donation. Okay. Right. Then we're going to ask ourselves the next question. What was this debt used for? Okay. Was it used to pay for a tax-deductible expense or to acquire an asset for which we've received allowances? In this case, it was for the purposes of acquiring a tax-deductible expense in the form of a trading stock that was already sold, and also to acquire a trading stock that is still on hand. So all the requirements for Section 19 are met, and therefore Section 19 is going to be applicable. Before we make that conclusion, we also need to take a step further to check whether or not there are no exclusions. Okay, so to check whether or not this debt benefit is not excluded in terms of Section 19. And we know that this debt benefit will not be excluded. Okay, remember I asked you in the previous recording to go through the exclusions to the provisions of Section 19 carefully. In this case, those exclusions do not apply. Right, so what are we going to do now before we go to the answer? Let's look at this table. Okay, we've been through it in the first session. From what we've read in the scenario, we can see that the expense or the debt was used to buy trading stock. And it was clear that some of the trading stock is no longer on hand. And therefore, we are expected to apply Section 19. And we could also see that there is 150,000 worth of stock that is still on hand. And for that part, we are comfortable that we need to reduce the cost of that trading stock that is still on hand in terms of Section 19.3. Okay. All right, so let's see. Let's go to the answer. Okay, how much was our debt benefit? It was 475,000. Before we do anything, we need to look at that 475,000 and see how much relates to the stock that is still on hand and how much relates to the stock that has been sold. Okay. So we're able to see that 150,000 relates to the stock that is on hand. So what are we going to do with that? We first need to reduce it we need to reduce the cost in terms of Section 19.3 by 150,000, okay? And we're going to have a balance of 325, okay? So what are we going to do with that balance of 325,000? What we're going to ask ourselves, what is it relating to? So that 325,000 relates to the stock that was purchased and it's no longer on hand. So there we're looking at Section 19.5. So we'll have recoupment in terms of Section 19.5. I want you to also think about the trading stock provisions. So in this case, the trading stock was purchased in the previous year of assessment. So we will not have a Section 11A deduction, but we are expecting to see the opening stock deduction in terms of Section 22.2 of 150,000. We were told that the stock is still on hand at the end of year of assessment, okay? But we are not going to have to add back in terms of Section 22.1, that 150,000 worth of stock that is on hand at the end of the year. Why? Because the cost of that stock is sitting at 0. Why is it sitting at 0? Because we've reduced the cost of that stock with the debt benefit of 150,000. Okay, so this is what you're expecting to see. Opening stock deduction of 150,000 plus 150,000, okay, because of Section 19.3. Closing stock in terms of Section 22.1 is going to be 0, okay, and the remaining 325,000 will be recouped in terms of Section 19.5. Okay, so let's look at our next example. Scrapbook. I'm not going to read the required again because it's very similar to the previous required. I'm just going to go straight to the scenario. Scrapbook Pty Limited also requested and was granted a concession on its outstanding debt from the following creditor, an independent party. Photoshop Limited for a computer equipment purchased on 1 October of the previous year for 350,000. SARS allows for a 3-year write-off period on computer equipment in terms of interpretation note 47. The computer equipment is used for the purposes of trade. 275,000 of this debt was still outstanding at the end of the current year of assessment. Okay, so we see that Section 19 will be applicable here and none of the exclusions will be applicable. Why are we saying Section 19 will be applicable? Because we can see that a debt benefit was granted and we can see that it was as a result of a concession, okay? And you can see that the debt was used to acquire an asset for which we have received allowances, okay? So now that we've seen that Section 19 is applicable, I'm gonna go back to the table, okay? Here's our table. Are we going to come here? No, we're not going to come to Section 19 alone. Because this is a capital asset, we know that Section 19 will also apply to capital assets together with paragraph 12A. But we also know that we always have to start applying the provisions of paragraph 12 cap A before we can apply the provisions of Section 19. Okay, so now that we've established that this is a capital asset and we've also established that this is an allowance asset, we need to ask ourselves another question, and this is a new addition to Section 19. Okay, is the asset still on hand during the current year of assessment in which we've received the debt benefit? In this case, the asset is still on hand, okay? So because the asset is still on hand, we first need to calculate the base cost, okay? And we're going to apply the debt benefit to the base cost. And anything remaining, we will include it in our gross income as recoupment in terms of Section 19.6. So let's go and do our calculations. Okay, so the asset was purchased for 350,000 in October of the previous year. The allowance for the previous year would have been 129,000. Okay, sorry, the allowance for the previous year would have been 29,167. Allowance for the current year, because it's the full year, the debt benefit was granted at the end of the current year of assessment. The allowance is 116,667. So you're sitting with a base cost of 204,166. So let's remind ourselves, how much was our debt benefit? Our debt benefit was 275,000. So what we're going to do is that we're going to reduce our base cost to nil in terms of paragraph 12 cap A. Any balance remaining, which is going to be 275,000 less the base cost of 204,166, will be recoupment in terms of section 19.6. And also, I want you to remember what section 19.7 is saying. It says that no further allowances must be granted once you've reduced the base cost to nil. Okay. Right, so let's go to the next example. Scrapbook Pty Limited requested and was granted a concession on its outstanding debt from another creditor, independent party as listed. The creditor here is Frame It Pty Limited. Okay, for the purchase of 2 small second-hand office blocks 6 years ago at a total cost of 150,000 each. One of these office blocks was sold during the previous year for 700,000. Okay, 630,000 of this debt was still outstanding at the end of the current year of assessment. 50% relates to the property that is still on hand, and 50% relates to the property that was sold in the previous year. The request for the debt concession was granted on 31 December of the current year. Okay. Scrapbook Limited had an assessed capital loss brought forward from the previous year of assessment of 150,000. Great. This example, we're going to see something different. Remember, with the first example, it dealt with trading stock. Okay, it's trading stock that was on hand, trading stock that was no longer on hand. The second example dealt with an allowance asset. Okay, and that asset was on hand. This example now deals with a non-allowance asset. And what is interesting about this example is that it is going to show us how to deal with a situation where the asset is sold in the previous year of assessment and when the asset is still on hand. Okay, so I really like this example. Okay. So we've already established that there's a debt benefit and that none of the exclusions are applicable. And we also have established that the debt was used to acquire a capital asset for which we were not entitled to allowances. Okay. So let's see how we're going to look at the answer. First, I want us to deal with the asset that is still on hand because it's pretty straightforward. Okay. So you know that the asset that is still on hand was purchased for 850,000. And 50% of the debt benefit, which is 315,000, relates to that asset. So what are we going to do? Because the asset is still on hand, we're going to reduce the base cost of that asset, okay, with the debt benefit. So how much will be our base cost? The base cost will be 850,000. Exactly the same as the cost of the asset because we do not receive allowances on this asset. You also need to understand why we did not receive allowance. I know the questions did tell us that we did not receive allowances. But even if the question was silent on that matter, we should have been able to pick it up because this is a second-hand office building okay? And therefore, we wouldn't have qualified for section 13, Queen. Right, so what are we going to do? We're going to reduce the base cost, which is 850,000, with the debt benefit of 315,000. So at the end of the day, we are left with a base cost of how much? 535,000. So in future, when we sell the property, our base cost will not be 850,000, but it will be 535,000. Okay, so let's now deal with the property that has been sold. We do not have that property anymore. It was sold in the previous year of assessment. Okay, so what are we going to do? We need to recalculate our capital gains. Okay, so we were told that the capital loss was 150,000 from the actual calculation, okay, when the asset was sold in the previous year. So what are we going to do now? With the recalculation, we're going to pretend as if we've received the benefit or the debt benefit in the year that the asset was sold, okay, or just before the asset was sold. So what are we going to do? We're going to say proceeds. We are told that the proceeds were 700,000. Okay. So we're going to now calculate the base cost. So we know that the asset cost was 850,000. So we're going to reduce that cost with the debt benefit of 315,000. So you're going to end up with the base cost of 535,000. So you're going to say proceeds of 700,000 less base cost of 535,000. We get to a gain of 165,000. What are we going to do with that gain? That's not the gain that we're going to include in our current year of assessment. Remember, that was just a hypothetical recalculation. So what are we going to do? We know that this is the gain that would have been recorded if the debt benefit was received just before the asset was sold. Okay, so we're going to say capital loss of 150,000 less capital gain of 165,000. And what do we get to? We get to a total capital gain of 315,000. Don't get confused. Don't say 165,000 minus 150,000, it gives you 15,000. No, that's not the case. Remember, you're moving from a loss of 150,000 to a gain of 165,000. So you're going to say 150,000 plus 165,000, and it gives you a total capital gain of 315,000, and that's what we're going to show as a capital gain in our current year of assessment. Okay, one last example. Oh, and the required, it's different, so I'm going to go through it. It says calculate the tax implications for No Fuss Pty Limited, the debt benefit for the year of assessment ending 31 December of the current year of assessment. Okay, right there in the required, we can see that there is a debt benefit. So when we're reading the question, we just need to go through the same process again. On 1 June of the current year, No Fuss borrows 1.5 million to acquire a new plant. Okay, so that 1.5 million was borrowed in the current year of assessment. Okay, No Fuss purchased the plant for a total cost of 1,450, 1.4 million, right? And used the remaining 50,000 of debt to fund tax-deductible administrative expenses. Aha. So now we're seeing something new here that we have not seen in the previous examples. The debt was used to pay for tax-deductible expenses. And right there, you're thinking about section 19(5). Okay. NOFAS has claimed allowances of 725,000 on the asset at the stage when NOFAS creditors discharged the 1.5 million worth of debt, okay, because NOFAS was unable to pay. NOFAS still held the plant at the date of which the debt was discharged. Well, it makes it easy for us, isn't it, if the asset is still on hand, because what are we going to do? We need to look at the debt and see how much of the debt relates to the tax-deductible expense and how much of the debt benefit relates to the asset. And once we've done that, then we're going to see the debt benefits that relates to the asset must first be applied to the base cost, and the remaining can be recouped in terms of section 19(6). Okay, so how much is our debt benefit in this case? 1.5 million. So the full debt was discharged. Great. Okay. So because the full debt was discharged, it means that the 50,000 deals with or relates to the tax-deductible expense, and for that it's going to be easy. We're going to do recoupment in terms of section 19(5) of 50,000. Okay, and the balance, which is going to be 1.450 million, it's going to relate to the asset. Okay, so we need to first reduce the base cost. What is our base cost? Allowances claimed, we are told, is 725,000. And how much was the asset purchased for? 1.450 million. So it means that the base cost was 725,000, and we're going to reduce that base cost to 0. Okay? And once we've reduced the base cost to 0, we are left with another 725,000 that we need to include as recoupment in terms of section 19(6). Okay. And that's the end of our example. And if you don't understand, you're more than welcome to give us a shout by email, or you can call us and we can. Okay? I wish you all the best with your test. Hope that you're hanging in there. It will get better. Okay. Good luck.